So dear viewers at the Profit Curve, welcome. And I know you guys are in for a surprise. We have with us today, as you can see, my favorite, one of my most admired people in equity markets and most humble people also, um, Mr. Gautam Baid, CFA. As you can see, he's here with us. Gautam, sir, first of all, a warm welcome to the Profit Curve.
Thank you for having me, Samir.
Uh, just to introduce this illustrious career that Gautam sir has had, Gautam Baid CFA is the managing partner of Stella Wealth Partners India Fund, a Delaware-based investment partnership which is available to accredited investors in the US. Gautam sir is also the equity advisor of Stella Wealth PMS, which is a portfolio management service which is available to NRIs as well as Indian citizens. So congratulations, sir, on this development. Also, it's a boon for our investors that now our investors can directly invest with you. Um,
Thank you.
Also, both funds are modeled after the original Buffett partnership fee structure and invest in listed Indian equities with a long-term fundamental and value-oriented approach. Previously, Gautam ji has served as a portfolio manager at Summit Global Investments, an SEC registered investment advisor based at Salt Lake City in USA. Before that, he served at the Mumbai, London, and Hong Kong offices of Citigroup and Deutsche Bank as a senior analyst in their investment banking teams. So, guys, आप सब जानते हो, we are in for a masterclass. Let's make it one. Gautam sir is also, now here comes my favorite. He's the author of international bestseller on value investing, which is The Joys of Compounding. In 2018 and 19, Gautam ji was profiled in Morningstar's Learn from the Masters series. So it's my honor, pleasure, and sheer manifestation that you are here with me, sir. I'll start asking you some things pertinent to Indian equity markets and value investing in particular. So, Gautam ji, tell us something about Stellar Wealth PMS and your wealth creation objective for Indian investors.
Stella Wealth PMS is a portfolio management service which is available to NRIs and Indian citizens. It's a collaboration with Complete Circle Wealth Solution in India. The reason for that is I'm already a fund manager of my hedge fund in USA, and as per SEBI regulations, I cannot be the fund manager both in US and India at the same time. So after I set up my India fund in the US, many people wrote to me, many NRIs and Indian citizens, saying that you've launched a strategy for US citizens, but what about all of us? So I said, I have to figure out a way to be regulatorily compliant and offer my philosophy for wealth creation to Indian citizens and NRIs across the world. So I collaborated with Complete Circle Wealth Solutions. They are
Okay.
a Delhi-based PMS firm. And the best part about the collaboration is that the founders of Complete Circle, Gurmeet, Chaddha, and Kshitij Mahajan, both of them and me, they share a very similar thought philosophy in terms of long-term approach, focus on quality, prudent diversification, and above all, our bullishness on India as a
Right.
country. Now, the thing which bonds three of us is that we just want to really spread the equity cult in this country and bring a lot of people into the equity culture and put them on the path of long-term wealth creation. I think through this collaboration, we hope to add a lot of value to our clients over the next few decades.
All right, perfect, sir. Sir, count me in also. I share the similar investment philosophy, and I've been following both of you on various platforms. And it's a treat, dear viewers, that Gurmeet Chaddha sir is in partnership with Gautam Baid sir. It's like the best of both worlds coming together from India and US and creating wealth in Indian equity markets. So great initiative, sir. More power to you in India. Um, Currently, as of today, as we stand, Nifty is at 18,600 levels, and there's no better time to ask you this question, Gautam ji. Do you think the Nifty at a PE level is overvalued, or is it fairly valued according to your genesis?
Right. So basically, here I would like to talk about a particular bias, which is called anchoring bias, which means basically clinging on to a meaningless or arbitrary reference point. Many of us look at the historical P/E ratio of the Nifty and just put out blanket statements like Nifty is overvalued compared to historical levels. But everything in the markets and in life in general has to be placed in the right context. Everything is contextual, right? That's how a rational person thinks. So if you look at what is happening inside the Nifty over the last 15 years, Nifty has been systematically, regularly deleting commodity, cyclical, and public sector companies which were trading at 5, 10 PE multiples and replacing them with very high quality consumer discretionary, consumer staples, IT companies at very expensive PE multiples, 25, 30 times. So to look at the historical PE multiple and then say that the Nifty is overvalued would be a wrong statement in my view. In fact, I'll just speak from a fund manager's perspective also. The Nifty is increasingly becoming a very tough benchmark to beat over a full bull to bear cycle, because when you're competing against the the best quality businesses of that the benchmark is made up of the best quality businesses of India, which is very resilient during a bear market and during market corrections. And that is the phase during which most of us fund managers struggle to outperform the benchmark. We fall a lot because we are focusing on small cap, mid cap stocks, whereas the Nifty, which is made up of all the strongest businesses of India, it is becoming increasingly resilient during a bear market. So it's over a full bull to bear cycle. It's not very easy to beat the Nifty in India, to be very honest.
Right. That's a great perspective. Again, you always give us some new points to ponder, sir, in all your interactions in the past also. I think that's a fairly good perspective. So you're saying it's becoming increasingly difficult to benchmark the Nifty and to beat it as fund managers. That's words of wisdom coming from you. Um, Also, sir, the Nifty, do you think it is concentrated in general, where let's say banks, NBFCs, and IT, just three sectors having a lot of weightage on the Nifty? Is this fair according to you, or should there be more sectors represented in our benchmark indices?
So again, I have to put this in context. So we have to understand how a benchmark is constituted or built up actually. Ultimately, it's all a function of market cap and free float. And where has been the maximum market cap creation in India in these three sectors which you have mentioned? So that is why the Nifty, so basically Nifty basically at any point of time represents where the bulk of the earnings profile of the country is as of that particular time period. So if as of today we are having a maximum representation from these three sectors in terms of the earnings, that is why the Nifty is overweight in these sectors. In the future, we'll have some businesses going out, we'll have some new sectors coming in. These things take decades. See, this is not a 1 or 2 year phenomena. Correct. Changes in the Nifty composition and the benchmark composition in terms of sectoral weights, sectoral allocations, it's a decadal phenomena. So, for example, contract manufacturing, in my view, is a very big decadal theme in India for the next many years. I think this particular investment theme is going to do very well because of our low cost labor. We have a distinct competitive advantage in this particular industry, contract manufacturing. So, not a stock recommendation, and we hold all these stocks in our PMS, so our views are biased. But look at all these contract manufacturers like Varun Beverages, Sirma SGS Technology, Navin Fluorine, SRF Limited, very strong contract manufacturers, and we are expressing our bullishness on this theme by holding these stocks in good allocation in our PMS. And I believe over the next decade, you will definitely see 1 or 2, if not more than 2 stocks from this particular theme become a part of the Nifty 50. They may become that large. They may become a few lakh crores of market cap over the next next one decade.
That's great to hear, sir. I think very well put out again. Dear viewers, again, a standard disclaimer. All stocks discussed in this conversation with Gautam sir are just for educational and training purposes. There is no stock recommendation to buy or sell at all. Please do your own research. At this juncture, I thought we explicitly make it clear again. Now, Gautamji, your views I wanted to know particularly on power sector and the potential risks. I'll tell you where this question comes from. Uh, as we all know, you know it better, sir. Everybody is talking about electric vehicles, and since 2020 till now, it's been 3 years. We have seen the power consumption in India actually has increased a lot. If I'm not mistaken, it has gone up 2.5 times. So someone who's looking at value at Stella Wealth, PMS, and is power sector something that I would just like to know your views on this sector.
So see, any business which is earning less than its cost of capital is destroy shareholder value if it tries to grow too fast. So most of the power distribution and power generation companies and power producers in India earn below their cost of capital, and therefore such kind of businesses become value traps. Basically, they look optically cheap, but if you buy them, you do not really create big wealth. The really big wealth, the really big multi-baggers come when you're able to find a value stock which offers you a lot of growth as well. So I'll again share an example here with you.
Please. Yeah.
Again, not a stock recommendation. When we hold this stock in our PMS, till recently, just a few months ago, Fusion Microfinance, India's second biggest NBFC microfinance company, was available at one-time price to book. Okay. And when you buy something at one-time price to book, it means that you're getting all the future growth for free, provided the company is earning more than its cost of capital. Fusion Microfinance was earning 20% return on equity. It was available at one-time price to book. And the single biggest reason we bought the stock in our PMS was last year, RBI, Reserve Bank of India, brought about a very big regulatory change, very big positive regulatory change for microfinance industry. RBI did two things. They removed the 10% interest rate cap for microfinance companies. So now the addressable market for microfinance companies goes up a lot, because now they can cater to all kinds of borrowers and they can price risk appropriately, because they are no longer bound by that 10% cap anymore. They can charge much more higher yields. And second, RBI has allowed all microfinance companies now to have 25% of their loan book in non-microfinance lending activities. Okay. Again, the addressable market of microfinance industry is expanded manifold. So these two regulatory changes, coupled with very cheap valuations, good return ratios, good quality management, you're getting everything at a bargain price. And and see, we have to understand, in the last 1.5 years, before up to 31st March, foreign institutional investors, FIIs, had sold $35 billion of equities in India. Okay, around 2.7 lakh crores of equity was sold by FIIs. Correct. Observe what happened moment from 1st April onwards till now, in the last 2 months. The moment FI buying has returned, where does that money initially go to? First, it goes to high quality large caps, then it goes to high quality mid caps, and then finally it goes to high quality small caps. And that is why when you buy such high quality small cap, mid cap stocks, you not only benefit from the earnings growth, you also benefit from the valuation re-rating driven by FI flows. This is a very fine nuance which many investors do not get, but this is the single biggest advantage of being in quality stocks in India, because when the foreigners come, they do not really pay much emphasis on valuation, because they are coming in with a very lower cost of capital. Correct. It has gone up a lot. This has gone up in the last 1.5 years, the cost of capital for foreign investors. But even then, when they come, they first and foremost focus on quality. And since I've worked I've worked as a portfolio manager of global equity strategy with the FI before, so I have an idea of how these FIs think. These guys focus first and foremost on quality. And that is why, in the last 1 month, you'll see Fusion Microfinance stock has gone up 20% already. It's still just at 1.2x price to book. So it's, it's but again, when you buy such businesses, when you are a fund manager, you develop certain way of thinking, and, first and foremost, you are a risk manager. So this industry is basically into subprime lending. Yeah. It is 100%, it is 100% unsecured. So you have to size your position appropriately. You cannot have very high weights in such kind of businesses, but you can generate a bit of alpha for your clients, but at least having some exposure of 3-4% in such kind of stocks. This is basically how you construct a portfolio. A well thought out portfolio gives you exposure to a variety of risk factors across businesses, business models, across industries, and you basically diversify prudently. So it's a very holistic exercise being a public fund manager.
Absolutely, sir. Thank you so much for that example. I think very well thought out and explicitly stated. Viewers, as you can see, I must, at this juncture, we are almost halfway through. I must stress on the point that please do read Joys of Compounding. I think it changed my journey also, as value versus growth and the various perspectives mentioned in the book. And like Gautamji mentioned right now, cost of capital is such an important paradigm for all companies to get over in their returns. So, great example again. And also, I have heard in your past interactions, Gautam sir, the recency bias. You mentioned a lot about the recency bias and how investors should safeguard against that. Now, a similar question which I have got in my interaction with investors. Let's say they are holding a stock, sir, and for whatever reason, due to FII selling or due to some market correction, the stock fundamentally fits their criteria, but it goes down 50%. I think in the last correction we had seen, especially in small and mid caps, sir, they had gone further down. So in mid caps, if it goes down 50%, now this is more of a behavioral kind of a question. You can answer in your own way, because in Joys of Compounding also you've mentioned more behavioral aspects. How does an investor develop that resilience and the capacity to hold on to such stocks that his faith and wisdom was correct and he's not wrong? How do in value, let's say, retail investors develop this quality, sir? It's a big gap in our market.
Correct. The answer to that is very simple. Have a diversified portfolio to various risk factors and different business models, because this will help you avoid FOMO, fear of missing out. Why? If your portfolio is exposed to a variety of tailwinds, so basically what will happen is, even if one or two businesses, or even if 5 out of 25 stocks are basically facing headwinds,
Right.
the tailwinds in the other 20 businesses will make sure that your overall portfolio performs decently well.
Yes.
This is what helps you stay the course with good businesses which are facing temporary headwinds. So, I'll give you one more example here. So, Loris Labs, not a stock recommendation again, and we do not hold this in our PMS.
Okay.
But it is facing pricing erosion in its ARV formulations and API division, and the stock fell 50% from the peak because management could not meet their previous guidance. But the management, Dr. Chava, is of a pretty good quality. He's a capable manager, and he has got a proven track record. And they are doing all the right things to diversify the business and to de-risk the business from sole dependence on a single business segment. So they're trying their best, but this diversification of a business takes time.
Yeah.
We always emphasize that we should have a business ownership mindset. But the moment any business faces a temporary headwind, we become impatient and then we sell. And the problem is, like you said, recency bias. We are basically going by the recent underperformance of the stock, and we get out of the stock just at the time the stock has bottomed out and it is about to go up again. It has happened to so many of us. We sell our stock out of frustration and then the stock starts going up, or we buy a stock out of FOMO and then the stock starts falling down. Both these instances are driven only by FOMO, fear of missing out, driven by recency bias. So focus on the long-term value of a business, focus on the capability of the manager and the promoter, buy it at a reasonable valuation. See, in India, I accept the fact that you will not find high quality companies cheap, except in 2008 and 2020. I haven't seen high quality businesses trading cheap in India. That's very rare. Just waiting for a decade for high quality to become cheap, that is not investing. Just waiting infinitely without any objective, that is not investing. You have to, in every kind of market, you have to keep hunting for value, even if it requires you to buy cyclical businesses at cheap valuations. When they are turning around, the industry cycle is turning around, you make money, then you sell that, pay the taxes, and then again move to the next opportunity. It is fine, but try to keep compounding your portfolio at a decent rate. Always think in terms of an overall portfolio level. Think at a portfolio level, because because in any normal portfolio, 1/3 of the businesses will be underperforming, 1/3 of the businesses will be performing average, and 1/3 of the portfolio will be performing exceptionally well. That is how a real life portfolio looks like. If all your stocks are going up at the same time, you can be rest assured that you're near the end of a roaring bull market and a big bear market is around the corner. This happened with me in December 2017. During that particular month, so many stocks hundreds of stocks were hitting upper circuits almost every day.
Yes.
And any experienced investor would have understood that we are on just on the verge of a big bear market which is about to start. And then from January 2018 to March 2020, we had a brutal 27-month-long bear market in which the small cap index crashed 55%, the mid cap index crashed 45%, and I still remember thousands of stocks in India crashed 70 to 80% during those 27 months. Just imagine if you're having a portfolio drawdown of 70 to 80%, you're basically taken out of the game.
Yeah.
The only thing which would have saved you in those 2 years was in being invested in quality. And that is why you have to be very conscious of the quality of stocks, quality of businesses entering your portfolio during a period of small cap euphoria. That is when we tend to let our guard down, and that is when the maximum mistakes happen.
Perfect, sir. Perfectly well synchronized again, and great example, I must say. So, viewers, as you can see, in a good cricket team also, there are one-third players who are stellar. Uh, and I use the term stellar for the reason like you will only have one Virat Kohli, one Surya Kumar Yadav, and one whatever, but you need one-third, as Gautam sir said, one-third of your portfolio will underperform at any given time. I mean, if it has happened with Gautam ji in his personal capacity, so just imagine that it can happen with a normal retail investor as well. But we have to pick good quality and hold on, as sir mentioned, because that is where majority of the money is made. And I also echo Warren Buffett here that, you know, good businesses work well for you when you are fast asleep and you don't disturb the wealth creation process. Um, uh, just final two quick questions, words of wisdom from you on this also. One is you have already mentioned microfinance, so I assume that that is one sector which you are looking at quite closely, and you know, although subprime lending is a word nobody wanted to hear in 2008, but I think now we are fairly past that. Any two more sectors, or let's say any one sector, sir, which you feel where we have a potential to create future multi-baggers in the next decade, where our GDP grows to $5 trillion plus?
I talked about microfinance, but I think the entire lenders as a basket, all the lending companies like high quality NBFCs, affordable housing finance companies, private sector banks, and small finance banks. I think all of these have the potential to create a lot of wealth over
Okay.
the next decade. Because for any emerging market to grow, or any developing country to grow, you need access to credit. Credit
Yeah.
is the single biggest driver of economic growth for a developing nation, and so the credit to GDP ratio of India is still very low. I think it's got a long way to go. And if you are bullish on India as a country and on the growth potential of this country, by definition, you have to be bullish on lenders. So we are very bullish on lenders as a basket in our PMS. We have a pretty high exposure there. Apart from this, I think electronics manufacturing services is also going to be a very big theme, because electronics is the third biggest imported item for India after oil and gold. And now we are trying to become self-sufficient or Atmanirbhar in this particular field. And this entire industry of electronics manufacturing sourcing is expected to grow at 30-40% at an industry level for the next 3 to 4 years. So I think that is also an area where we should definitely have some exposure. So electronics manufacturing services and lenders in general, I think these two are pretty good pockets. And an evergreen theme in India is branded discretionary consumption. So if you're able to find good brands, good solid brands at a small cap or mid cap market stage, you should buy them and just simply hold on to them, because as India's per capita GDP goes up from $2,200 to 3,000, 4,000, 5,000 and above, the basic spending on items like food will not go up much, but the spending on branded discretionary consumption and financialization of savings, these two categories are going to simply witness an exponential jump. So that is where we have also tried to acquire some very leading consumer brands in our PMS portfolio for our clients, and also we are very bullish on the financialization of savings team. So we are also having some exposure there as well.
Wonderful, sir. Wonderful. Dear viewers, one more thing. Stella Wealth PMS, as you heard from Gautam sir, is very much active in India. It's both for Indian citizens as well as NRIs. So do have a look and have a consultation as to what kind of portfolio suits the investor psychology, as Gautam sir mentioned. And I'm sure if your vision and your focus is there, I think good stocks will come in your portfolio through the right PMS. So holding the right decision is very important, as Sir mentioned. Um, so one major mistake, according to you, which I was going through joys of compounding like for the third time, but any one major mistake that investors should avoid, by nature should avoid.
So I'll speak from a personal example. I'll talk about my biggest mistake. So it was in terms of absolute loss. The biggest loss I incurred was on a stock called Bandhan Bank, where basically after reading Tamal Bandyopadhyay's book, Bandhan, The Making of a Bank, I developed what is known as liking bias for the promoter of Bandhan Bank, Chandrasekhar Ghosh. I got very emotionally attached to him after reading his story of hardship, struggle, and perseverance. Because even I've gone through a similar journey in life. So I feel the big mistake which I did was I failed to separate the economics of the business from the personality of the promoter at the helm. And even though I was facing negative information, disconfirming evidence that the business is going downhill, asset quality is worsening, it's facing a lot of issues in its core markets of West Bengal and Assam. I still ignored all those facts in plain sight, and I paid the price by booking a big loss in that particular business. But I always tell people that when you view all these losses as valuable experiences, then you basically never lose. You either win or you learn, basically. So that is the right approach to take. These mistakes tend to be your biggest teachers. The most valuable lessons are provided by mistakes, especially the big mistakes. So I think I'm very thankful, that I was able to learn from my mistakes. And in my book, I write a particular thing. I write a very important point that all investors make mistakes,
Right.
but the great investors repeat the past mistakes, old mistakes less often. If you
Correct.
can simply avoid repeating the prior mistakes, avoid repeating the old mistakes, that itself is half the job done. Just keep learning. See, new mistakes will always, because human beings are a messy living compilation of a multitude of behavioral biases. We'll keep making new mistakes all our life. But at least the very minimum we can try to do is avoid repeating the old mistakes. And that is why I maintain an investment journal in which I document all my decisions, I document my learnings and reflections on a regular basis. And it greatly helps me in learning a lot about myself, where are the areas where I mistakes, why I make them, what have I learned from them. I think it's very, very useful for me.
Wonderful, sir. Wonderful. I actually missed out on that point in the beginning. Viewers, please, if you are a trader or an investor, more likely if you're an investor, let's say you're a value investor, like Gautam ji mentioned, one thing which I can also say I picked up from Gautam ji's wisdom is that investment journal. I think journaling is so important any which ways in life, but especially if you're picking stocks and maintaining an investment journal, like sir had mentioned in one of his interactions, and that sometimes the past patterns, let's say 4 5 years back, if you can just refer what were your mistakes, and as he said, we have to avoid repeating the mistakes, do less of them, take it like a test match कि हर बॉल पे आपको बाउंड्री नहीं लग सकती है, you have to leave those balls outside the off stump. That analogy I think works well for value investors in India. One last question, sir, before we wind this up. We have seen a lot of past investment patterns across countries, be it US, India. Even if we talk about India, so there is a general consensus, sir, that patterns keep repeating. Uh, but going further, like we are at an inflection point, as you mentioned, $2,500 per capita. Do you think anybody who's studying now coming to a student or a young professional starting his investment journey, can he or she infer the same wisdom from the last, let's say, 30, 40-year patterns, investing patterns?
I'll share the example of three stock markets with you: US, China, Japan. Just simply observe what happened to the stock markets of these three countries when their GDP went from 3 trillion to $6 trillion.
Okay.
Their stock markets did not just double when their GDP doubled. Their stock markets tripled or even quadrupled. And why did that happen? It's because when a nation transitions from a low per capita income country to a middle income per capita country, as India is doing today, we are at $3.3 trillion of GDP, and we're transitioning from a low per capita income country to a middle income per capita country. We should keep in mind that even today, 80 crore out of 140 crore Indians still receive subsidies from the government. So we are still a very poor country. The per capita income is still very low, right? So as we transition from a low income per capita country to a middle income per capita country over the next decade, the two areas which I always emphasize, branded discretionary consumption and financialization of savings, these two categories created maximum wealth for investors in US, China, Japan in the past, when those countries' GDP went from 3 trillion to 6 trillion. Same thing I can say with a reasonable level of certainty that it can repeat in India as well. Now, here again, to close the discussion, I would like to say a very important aspect of investing, and all investors should inculcate this mindset that think probabilistically rather than deterministically, because in investing nothing is black or white. It is always shades of gray. Even the best of the businesses come with some risk attached. There's nothing like a perfect investment. If anyone is pitching you a perfect investment or a risk-free investment, he's basically trying to scam you. Basically, there's nothing
Right.
like a risk-free investment or a perfect investment. Every investment comes with some form of risks, and as investors, we all have to live with the risks that we can understand and tolerate. That's what investing is all about. Think in terms of probabilities and size your bets appropriately. Wherever you find asymmetric risk reward bets, very high risk reward ratio, where you allocate more, and where you find a reasonable level of certainty and a reasonable level of confidence, allocate less. Basically, this is how you have to approach investing, from a probability lens. It's the moment you develop a probability mindset, you'll make vast strides as an investor, because it will help you in so many different areas like risk management, portfolio construction, position sizing, sectoral exposure. There are many finer nuances which come with thinking like a probability risk taker. You're basically taking calculated risks, basically.
Right, right. Amazing, sir. Amazing again. I think viewers, so rather than having a fixed mindset, we need to hedge our risks and have a higher probability. जैसे जिसमें higher probability है, probabilistic mindset. Again, words of wisdom from sir coming that this is why the patterns will work, and this is how India also on the growth part, we can be a part of this capital market growth in our country. I think so, we are the fifth largest capital market so far in the world. Yeah. So with that, thank you so much, Gautam sir. It was a pleasure having you on our channel, The Profit Curve. I think your experience, your humility, the journey that you have had, the resilience that you have shown as a person, as an investor, is really inspiring for my viewers. And I wish you good luck from the bottom of my heart at Stella Wealth PMS in India.
Thank you, Samir. This was a pleasure, and I wish all the subscribers of your channel all the very best in their lives and investing careers. Thank you so much.
Thank you, sir. Thank you.